Welcome to the session, everyone. This is Jose Blasco speaking. I am about to remove the introduction image so I can say hi, as I always do, from the bottom right side of the screen. How are you, everybody? It's good to see you all. Getting ready here for our session today. Excited, and just wanted to turn on the disclaimer on the bottom part of the screen so everybody has the opportunity to read it completely while other attendees are joining the session live. You may be watching this recorded later on, so the disclaimer is also for you. It's important stuff. It's financial markets, isn't it? So there is risk involved, and hence the disclaimer. Anyway, today we are getting together to talk about futures options. That's the plan. Okay, we're going to be talking about futures options. This is a video, this is a session that we're doing live that then will remain as a recording in our YouTube channel, which is being produced for you guys out of your demand. Some of you who are part of our community have been attending some of the recent trainings that we have been doing when it comes to options trading, especially looking at options in a daily basis, like zero DTE type of options. Very trendy and very convenient these days. And because of that, we looked at different ways on how to approach it: index options, futures index options. And therefore, the question was, how do we deal with futures options? And the idea today is to talk about futures options, meaning that everything you know about options, if you trade options on equities, applies. But there are a few subtleties, a few things that you need to know that will help you to avoid mistakes and will help you to be more efficient with your options on futures. Because now you'll be trading a derivative on a derivative, which sounds very scary if you never trade derivatives, but it's actually very convenient. Okay, it's just another layer of things that we need to know to trade those products properly. Okay, and this is why we are getting together today. So I'm going to be looking at the chat box. I see that some of you already typed there. It's great. I would like to request, if I may, everyone to be interactive during the session. If you're attending live, if you're attending this in a recorded fashion, for sure, if you have questions, you can always attend our question section on the website and type your questions, so we'll give you answers, or you can even email me, and I'm happy to help. But for the ones of you attending live, Mark, Jeff, I see multiple more people connected live at this moment in time, so please say hi on the chat box. And as always, Mark and Jeff are first in line to say hi, which is super appreciated. Thanks for that. Okay, so we are 3 minutes into the session. I would say probably I gave enough time to everyone to join on time, and it's time now to get started. Okay, so what are we doing today, right? So we're going to be talking about options on futures. Okay, and the first thing that we need to talk about, because today is going to be a little bit of an application, a little bit of a lecture, it's going to be a mix of things. And so the first thing that we need to understand is what's the difference between an option on an equity, an option on a stock, for example, or an option on an ETF, which is something that the majority of options traders may trade or are likely going to be trading. What's the difference between an option on equity versus an options on futures? That's the big difference. Okay, that's the conversation we're having today. And even in between that, I would also want to plug in, because it's all related, to be honest, what's the difference between an option on equity versus an option on an index versus an option on a futures contract. Okay, so options on futures versus index options versus options on equities. That's the conversation we're having today. Okay, and I would like to start by asking you this question. Okay, in your mind, and please use the chat box, in your mind, so what's the difference between an option on equity versus options on futures, or options on equity versus on index option, or index option versus options on futures? Okay, so please go ahead and type, and there's no right or wrong. This is just to warm up. Okay, so please go ahead and phrase your thoughts in the chat box. Okay, that would be great. How are you, Siva? Good to see you. Sergi as well. Good to see you as well. Wonderful. Thanks for those messages, my friends. So I'll start giving you the answer, okay, as you are hopefully typing your views, even though you are probably attending today's session because you want to learn about it. So maybe you are undecided about your view, and that's why you're here. But while I give you more time to type, I'll start phrasing the answers, okay, to this very important question. So to be honest, the answer is super simple. The difference between an option on an equity, for example, and an option on an index, it's actually the underlying. That's the biggest difference. There are more, but that's the real biggest difference. Because, for example, if you trade options on an index versus you trade options on, let's say, McDonald's as a stock, well, you could certainly get assign or exercise your options right and get delivery of McDonald's shares if you trade options on McDonald's. But there is no way for you to get delivery of the S&P index. If you trade options on an index, given the fact that an index is not a tradable thing, an index is a mathematical calculation that gives you a chart that measures something. In the case of the S&P 500 index that I have on the screen, it measures the average performance of the 500 stocks that make up for the S&P 500 index itself, and you have the average performance. That's what the chart shows you. But you cannot buy or sell, you cannot buy long or sell short the index. It's not a tradable thing. Therefore, the direct consequence of trading options on equities versus options on indices is the fact that options on indices will have to be cash settled. They have to, because when it's time to be assigned or have a physical or have an exercise, because you cannot get anything, because the underlying asset is not tradable, so then options on indices are going to be cash settled, where options on equities, okay, are going to be a deliverable product. Okay, so they may not be cash settled, and you may get actually the stock shares in this case. Now, not that I use the word may, because again, common sense suggests it's like that, but then the reality is that there is a lot of exchanges. There are many exchanges in the world, and maybe there's some exchange in some country that is a very small exchange. Maybe is trying to create a product which is very different compared to everything else, and trying to attract liquidity this way. And next thing you know, that exchange in some place in the world end up with options on stocks which are cash settled. This is certainly a product that could exist, but it's not a common thing at all. The common thing is that when you trade options on equities, typically you get delivery of the asset versus options on indices, you get cash settlement. This is something very important to get started with this conversation. Okay. Both the options and the futures have expirations. Very good, Mark. That's a very, very good point, which I'm coming there. And that's why I started with the index, because the index, it's not a tradable thing, so it does not have an expiration. The index never expires. So just like the stocks never expire, unless one day they went bankrupt, the index never expires either, and therefore options on stocks and options on indices would have, you would think, the only difference is the fact that options on the index are cash settled versus options on the stocks typically not. Now, what if we add to the conversation now the options on the futures? Okay, what if we add now to the conversations options on the futures? Well, options on futures may or may not be cash settled, because the reality is that if you have, let's talk about the S&P index, for example. So let me rephrase that. The S&P 500 futures, that's what I meant to say. So if you're talking about the S&P 500 futures, which is the ES contracts that trade in the CME exchange. So if you talk about that product, you can certainly go long and short that futures contract. So if you trade options on that futures contract actually allows you to go long or short. And therefore, you could have options on futures that imply a physical delivery of the futures contract. So if you get assignments or you exercise your options right, so you get something, which in this case would be being long or being short a futures contract. So that technically is possible. Having said that, typically this is what happens with commodities. options on commodity futures. That is typically the case. When we are dealing with equity indices, in the futures arena, for example, S&P futures, Nasdaq futures, etc., many times with most exchanges, with most products, even though exercising your option could give you, you know, a delivery of something, because you have a futures contract on the other side, and futures are tradable. Indices are not tradable, but futures contracts are tradable. So then you could, in theory, get that. But the reality is that I guess it's coming from tradition or history or habits in the marketplace. The reality is that, for example, if you trade options on the S&P 500 futures, they are actually cash settled. So maybe I drove you crazy, because the fact is that we have multiple possibilities for combinations. The one that is very clear is the one that it's definitely not confusing is when you trade options on indices. For example, options on the S&P index, also known as SPX options. So, for example, here, do I have SPX? Yes. So I have loaded here on my TWS platform SPX options. Notice the word index. So these are options on the index. So if I buy or sell that call or put, for example, this put here on the right, so I'm gonna pay 960 or receive 950, and if I exercise or get assigned, I get cash settlement, because there is nothing I can do. And actually, the exercise cannot be done unless it's on the expiration moment, because it's an auto exercise. Since you cannot get delivery of anything, you cannot do it in the middle of the life of the option. If I get technical, I would say that's a European style option. Okay. Anyway, so that's very easy to understand. Options on the indices. Options on the equities. You have two choices. They may be cash settled or maybe not. The reality is that in the US market, which is the largest market in the world, every single option on a stock or option on an ETF is not cash settled. You get delivery of the stock or delivery of the ETF shares. So, it's common to assume that, because it's equities, it's going to be delivery. Well, no, there may be some exchanges somewhere in the world. I don't have a fresh example in my mind right now, but there are indeed cases where you trade options on stocks or options on ETFs, and they are cash settled. It's very rare. I don't know where, but that exists. Okay. Rule of thumb, options on equities, are typically leading to delivery of something. Okay. And the last case, which is the most confusing because it's derivative of a derivative, if options on futures. So again, it could be anything, because just like stocks, you can trade long or short. Futures contracts, you can trade long or short. And therefore, when you trade options on futures, in theory, in the theory world, you could get a delivery of a futures contract. But the reality is that, I guess, again, it's tradition or history or customs in the marketplace. The reality is that when you're dealing with options on index futures, for example, options on Nasdaq futures, options on S&P futures, so typically those options are cash settled because it's an index, whereas if you were to trade options on a commodity, for example, gold, so again, unless I'm mistaken, because there are many futures contracts and they all have their contract specs, I believe I'm not mistaken, so then you will get physical delivery of the futures contract. Okay, you will get physical delivery of the futures contract. If I'm by the way, that's probably not a right way to say it. You will get electronic delivery of the futures contract, because the physical delivery would be now, if you hold the futures contract into expiration, now you get physical delivery of gold, for example, right? So physical delivery of the futures contract, to be honest, is not a totally proper term, even though I guess it's okay to use it. So that's the first thing I needed to have in this conversation, to make sure that we don't make a big mistake. Okay, with expecting to get something or not expecting to get something, and then you look at your account and you are long or short a contract and you didn't expect that to happen. Okay, so it's important that you keep that in mind. And the first thing in this conversation we need to have is a conversation about the underlying asset. So when you trade options on index, the underlying asset is the index. If you trade options on futures, the underlying asset is the futures contract. And as Mark said perfectly, and I see other messages in the chat box, I'm coming for you guys, but as Mark said perfectly, because you have different expiration dates for the futures contracts, each of the expiration dates acts as a different underlying. And if options give you options, if options give you choices, so options on futures give you choices on steroids, because each future expiration becomes an underlying base to derive an options contract from, which now every options contract that derive from that expiration futures have their own expiration and strikes, right? So, wow, bottom line, you will see, it's crazy simple. But I do need to make you aware of the vast amount of choices available out there. Okay, so I'm gonna show you that very clearly here on the platform. Before I do it, let me keep a look, take a look at the other messages. James, good to see you. Nice to have you. Vishal, my friend, it's such a pleasure, such a big smile on my face right now to see you. Thanks for joining me. Michael, very nice to see you as well. Very nice, guys. And again, um, right now we're just warming up for the lesson. Okay, so the lesson is about to begin. So be ready with questions and answers. Okay, and to be interactive. So what do we have? Well, let's type here ES. I'm gonna type ES, which is the root symbol for S&P 500 futures out of the CME. When I do that, and I'm using TWS, which is the platform provided by by Interactive Brokers, notice that it gives you a menu here with so many choices, because there are many things out there in the marketplaces globally that start with ES. It could be Eversource Energy in the Mexican exchange, or it could be the E-mini S&P 500 out of the CME. That's what we want to chart. But inside here, you can look at the E-mini index or the E-mini futures contracts. You can also load a specific futures contract by picking the expiration and all of that. But that in my mind is a bit too complicated. It's actually way simpler to load just the futures contract. Okay. Now, if I click on the futures contract for the S&P, so another platform is telling me, okay, do you want to load the futures contract? Which one? Do you want to load a continuous chart? That's what we normally do when we trade. Let's say you are a futures trader, trading options intraday. Let's say you're using 5-minute time frames and you just want to load the whole chart and you plan your intraday trades. That's what you normally do. But in this case, I'm not going to do that. In this case, I'm going to go for the specific contract. Okay, and by default here, TWS is giving me 3 expiration dates. There are more expiration dates. Okay, there are many more. You can actually load many more things. Okay, more. So you can load the whole thing. You have multiple years of expiration dates. But of course, the far away expiration dates in the futures markets, they won't be liquid. So if the futures are not going to be liquid, well, forget about the options. So unless you are building, some sort of a long-term play for a hedge, you are a commercial company instead of a speculator or something like that, probably that doesn't make sense at all. And TWS knows that. So basically they are giving us 3 choices, which are the 3 next expirations in futures, not options, in futures. Of course, the most liquid one is what we call the front month, which is currently December. In futures, in future indices, typically the majority of equity indices in the world, no matter the exchange, typically they trade with expiration dates using March, June, September, December. So this is HMUZ. You probably know that. So we have the Z in front of us, which is December. So I'm just going to click on it. And if I click on it, what's loading now on the top is my December expiration chart. And what's loading in the bottom part, loading here, as you can see, it's the options that derive their value from ES December. So right now, we are dealing with options linked to the underlying being December 15. Okay. And for example, just so I'm visual, I'm going to use, let's say, December 15 expiration. Okay, December 15 expiration. And I'm going to load the nearest 4 strikes. And I want you to remember 45.75 to 45.90. Those are the nearest strikes to the current price. The current price being right here, 45.85.5. That's the real-time price of the S&P futures December expiration. So the nearest strikes are 45.75 all the way to 45.90, right? Using December 15 expiration, which is 8 days from now. Now, what if instead of using December expiration, I go back to type yes, I go back to select futures, but now instead of using December expiration, what if I use March expiration, which is 3 months later? Well, notice that the real-time price, I just froze the screen, the real-time price of the S&P futures is 45.84, where with December, whereas the March expiration has a different price. Why? Because of the contango effect, contango or backwardation, because of the cost of carry, because of the interest rates, because of how futures contracts are priced. So each expiration date has a different price. So what happens if instead of loading the December expiration as I did before, what happens if I load the March expiration and I use March futures as my underlying asset? Well, now what's going to happen is that a different option chain is going to load. Whereas if I do the same story, which is pick December 15 expiration, and I was to look at the 4 strikes, so notice now how the nearest strikes don't go from 45.75, it starts at 45.80, and it ends at 45.95. So notice how, while I'm using the same options expiration date, the strikes that are the nearest to the current price are different. And this is because the price of the underlying asset, in this case the March expiration, is different. Therefore, the cash settlement, if I was to trade these options, would be depending on the options expiration date based on the March contract price for futures. So let's say I buy the 45.85 call, and on December 15 expiration, that call is in the money by 10 points. I'm going to get 10 points cash settled in my account as a profit. But that 10 points would mean the difference between 45.85 and the current price of the March futures expiration. If I was, let me say that, and then I'm going to ask everyone if everybody's with me. Oh, no, I just clicked on the wrong place. If I was to load the December expiration for futures, which is, as we said, a different current price, and I was to look at the same December 15, 8 days to go, okay, December 15, and I was to, let's say I was to buy the 45.85, and on expiration, on December 15 expiration, that contract expired with 10 points in the money. For me to know I got 10 points in the money is because the difference between 45.85, which is the strike of the option, versus the price of the December futures contract, that would be 10 point difference. In other words, while I'm looking at the December 15 expiration option, the December 15 expiration option that derives its value from the December futures expiration, it's a totally different animal versus the December futures expiration that derive its value from the March futures expiration. Just like, I'm going to repeat that because it's important, and I said it quite fast. Just like if you were to look at the December expiration on Apple options versus the December expiration on Tesla options. It's two different animals because it's two different underlying assets. In this case, I'm going to say that slowly now, the December options expiration out of the December futures contract, it's a totally different animal compared to the December options expiration out of the March futures contract. Hopefully I didn't say it too fast this time, because a typical mistake here would be that you come to a trading platform and maybe you use Interactive Brokers, maybe you use another platform. But typically, platform providers try to make your life easy. And there are certain platforms that are amazingly user-friendly. But this may open a danger here because you may load a continuous expiration right? And in your mind, you have a continuous expression chart here is beautiful, but now when you're looking at your option chain, right, by mistake, you may end up picking, the wrong underlying. So typically what the broker would do in a case like that is that it would only show you the options related to the front month contract, which is typically the most liquid one in futures. So this would be equivalent at this moment in time, since the most liquid contract for futures is December. So this would be equivalent to me, instead of loading the continuous, you can see the infinite sign here, instead of loading the continuous, if I was to load the December only, so I will get the same list. But maybe you have a different intention and you actually wanted to trade the options that derive their prices from the March expiration. And if you loaded the continuous chart, then guess what? You are actually trading the wrong underlying asset options. Okay, so again, there is an extra layer here that adds so many more choices. The reality is that in 99 or 99.999% of the cases, I bet, even though this is not a formal statement as a trader, but I bet that you probably want to trade options on the front month futures. So therefore, even if you were to type the continuous symbol, probably you are dealing with the right option contract when you look at the option chain, but maybe not, and then you are making a terrible mistake. So summary to this point, we said, okay, and I'm going to ask you a question here in a moment, okay? So and I can see more comments on the chat box, so I'm coming for you, Siva, give me a moment. So far what we learned is, number one, apart from options on equities, you have options on indices and options on futures. And the one difference is the underlying. If you trade options on the index, because the index is not tradable, so then options on the index will be cash settled. With futures or equities, we said it may or may not be the case. It depends on the exchanges, on the regulation, on the country, on tradition. Typically, when something is deliverable, like a stock, the options imply delivery, not cash settlement, typically. But in the case of index futures, for equities, most index futures products are actually cash settled. Okay, and commodity futures are often deliverable, meaning if you get a sign or you exercise your options contract, you get the futures contract. So you get an electronic delivery. Then, if the futures contract expires, then you get the delivery physically of the asset, unless you have some sort of another process with your broker or something like that, because each futures contract got their own contract specs, and and you have various dates to watch apart from expiration, but this is not the subject for today. So hopefully this is clear. My question to you all while I look at the chat box is this clear? Is everybody with me? Please let me know if this was too confusing, if I went too fast, if you need me to rephrase something. Hopefully it was fine, but let me know in the chat box. If all is good, please type good or okay. Okay. Let me see. Siva, can futures contract and options expire on the same day? Yes. Because options expire once a quarter. Let me rephrase that. Because futures expire once a quarter. I'm talking about index options that expire once a quarter. Futures on crude oil, for example, they expire every month. Okay, but no matter what, because you always have an expiration date on those futures contracts, and most options on futures these days, they provide 0 DT. 0 DT means 0 days to expiration, meaning daily expiration options. Okay. So what happens is that you always have cases where futures and options expire at the same time. And even for the products which are less liquid, that you will not expect to have daily expiration options because they are not so liquid. So maybe you only have expiration every 3 months, for example. Okay, and options also give you maybe expiration dates, maybe weekly on the Fridays or something like that. Well, guess what? In the end, there would be a coincidence on the futures expiration date. The option would also expire because you cannot have an option alive without its underlying asset class, because the option derives its value and has reason to exist because there is an underlying asset. So if the underlying asset expires, guess what? The option also needs to expire, worst case that day, even though you may have more expiration dates, but definitely that day, there will be an expiration date for the option too. Okay? So yes, very good. So Mark says good, Michael says good, Segif says good. So last trading day of futures contract is some days before the expiry day, right? Last trading day. Does that impact the options expiry date? No, the last trading day of the futures contract is still tradable. What happens, and this varies per contract, because again it comes from history and market tradition, if you wish. There is a fantastic website where you can see that very nicely, which is barchart.com. But each futures contract is tradable until the very last moment, until the last very second. The fact is that it's tradable until the last moment, but the rollover process starts a few days before typically. For example, December, okay, December 15 is the expiration date for S&P futures contracts. I'm talking about futures, not options. So the S&P futures contract expires on December 15. That is the third Friday of December. Typically, on the second Thursday, so that's the week before, on the second Thursday, that's when rollover takes place. In other words, everybody that is trading December, on the second Thursday of December, stops trading December and starts trading March. So now, the volume, the majority of the trades that were taking place in December stop, and all those trades are now happening with the March contract. But it doesn't mean you cannot still trade the December contract. You could keep trading it all the way until the very last second, until December 15 reaches 5 p.m. New York time, which is 4 p.m. Chicago time, and that contract, that market closes, and therefore the contract now expires. Until that moment, you could trade. Of course, you're going to have terrible bid-ask spread, you're going to get slippage, but you could. Okay, so the option would expire at that moment. Okay, the option that uses that December contract as the underlying would expire at that moment too. Okay, cool, great questions, everybody. Very good. Okay, so good. So okay, so then what? Well, very simple. When you trade options on futures, which is the topic for today, you need to deal with the right expression on your chart. Okay, for example, here I am looking at SPX. So I'm using TradingView and I typed SPX. So of course you can load many things, right? But SPX is an index. So just to narrow down my search, I'm going to type index. Okay, and notice here that you have a CFD. Well, that's a over-the-counter product. You have another CFD, over-the-counter product, and here you have index Chicago Board Options Exchange. That's the one. So if I click on that one, I am loading the chart of an index, and now let's say I do iron condors in a daily basis, and maybe what I do, like I taught in some lessons, maybe you are looking at pivot points, and the price is here, so you look at 2 pivot points above, and you draw a line. Let me do this. You draw a line here, 2 pivot points above, right? And then the price is here, you look at 2 pivot points below, and you want to draw a line, but you also look at a UFO, right? So in other words, now you're expecting, oh, sorry, I didn't get the line. Here we go. So now you expect that during the day, okay, the S&P will do whatever, but stays between the black lines. And then maybe what you do, you do an iron condor, which is buy a call, sell a call above, and sell a put and buy a put below. Okay, so maybe that's what you do, and that's your daily play, and that's how you do it, and done. Well, if you do that with SPX options, that's it. Because there is no multiple expiration dates for SPX as a ticker symbol for the chart. As an underlying asset, the index is the index. Okay? So what would you do? You would come to your trading platform, you would type the ticker symbol for the index, select index, SPX, CBOE index, and now the option chain that is about to load refers to that, to the index. So let's say you want to do 0DT, so you would just make sure you use today's date. Okay, and then let's say you want to do the strikes 4620 and 4540. So 4620 is here. use 2 strikes above and 44, 45, 40, and let's say 2 strikes below. So if that was your condor, okay, 46.30 call, 46.20 call, 45.40 put, and 43.40 put. Again, I mean, we are in the middle of the day, and I select strikes which are extremely far away, so the premiums here are very tiny, but that's not the point, because I'm planning this trade at the speed of the light. I'm not doing it correctly, to be honest, but that would be it. So you would now, you want this one to buy, this one to sell, this one to sell, and this one to buy. And if that was the case, so congratulations. Well, actually, no congratulations, because I'm missing one unit. I didn't sell that one. Now, yes, congratulations. You have an iron condor, 4 legs, okay, 2 calls, 2 puts, 2 buy, 2 sell, and that's an iron condor. And now you just go and you take a trade. Okay, that's it. It's just like if it was an equity or a stock. Very simple. Okay, I want to give you another example, by the way, today, because we always talk about U.S. products. Okay, and obviously nothing wrong with U.S. products. Fantastic exchanges, fantastic liquidity, and everything else. But there are other things you can trade as well with the same concept. For example, what if you want to do DAX options? Okay, so DAX, it's a product that trades in the Eurex exchange. Okay, it's a European product. It trades since actually. Not the DAX, but the options on the DAX. The trade starting around 3 a.m. in New York, and all the way until the close, U.S. market close, even though it's a European product. So in other words, there is an overlap. During U.S. market hours, you can be trading that European product electronically. It's the same thing, exactly the same thing. Now, you could trade FDAX, okay, which is DAX futures, from the Euro exchange, and you can trade that just like you would trade S&P futures, or you can load the DAX index, where the DAX index is provided by Xetra. Okay, Xetra is the company processing the calculation of the index. Okay, so here is the index. Okay, so the index is currently trading at 16,623. So what can you do? Same story. Just like I did SPX options, you can come in here and type DAX. And when you select DAX, you can go for DAX index. DAX 40 index, Deutsche Aktien Exchange 40. So you click index, and that transition will load. I'll take a sip of water. Here we go. And same story. Notice how you can also have your, I need to check mark right there, okay? Weekly and quarterlies. So check mark weekly and quarterlies, and now magic. I got my daily, okay? And yeah, there is a problem, and this happens from time to time with options on futures, because I am using, as you can see with the red line, the red band on the top, I'm using a simulated account with an interactive broker, and sometimes with a simulated account there is a little bit of issue with the data feed, so it's showing December 8 instead of December 7. So you know what, instead of looking at the DAX, let's look at the Euro Stock 50, which is another European index, also out of Eurex. So this is the Eurex Euro Stock 50 index. Okay, so same story. You can, I mean, let me show you that properly. So if I show FESX, okay, and I go for futures, so here is your Euro futures, Euro Stock 50 index futures. So just like the DAX futures or the S&P 500 futures, you can load a chart and you can trade this product. Okay, you just came to this UFO and bounced, and you just trade it intraday like any other product. Okay, now what if you want to trade options on Euro Stock futures? Let me rephrase that. What if you trade options on Euro Stock index, which is the similar thing as saying you want to trade options on the S&P index, but instead of in the US, that's European, right? And again, the trading hours overlap, so no problem. By the way, super convenient in Asia. I'll talk more about the Asian hours if you happen to be an Asian trader. Very, very convenient to trade at this time. So let's load Euro Stock 50 index. So the Eurostock 50 index is not tradable. It's an index, like the S&P index or the DAX index I just showed you. They're causing the futures contract, but we are not talking about the futures contract now. We are talking about the index. So what happens? You can come into here and type Eurostock 50 index, ESTX 50 index. And the moment you do that, so here you have, and you have December 7, so 0 DTEs. Okay, with the DAX, we also have it. It just didn't show because it's a simulated account, and sometimes that happens. Okay, but what happens? So now you have your 0 DT. Okay, just give me a moment. Having an issue to scroll for whatever reason. This is something that is happening, I believe, because I'm sharing my screen. Okay, now it did. So December 7, 0 days to expiration. You can see that, 0 days. Okay. So now, so you have, your strikes. And now, again, same story. Let's say, I'm just going to randomize this. Okay. So let's say you expect the Eurex to stay between the black lines, and the black lines are, whatever. So 44.90 and 44.65, right? So you would just come in here and get 90 and 65. Okay, so 65 and 55, and then you get 90 and 00, and you have it here. So you buy the 55.00, sell the 44.90, etc. And you can just place your iron condor here and treat it exactly the same way. Okay, and I'm missing a few ticks here for whatever reason that is, but I believe it has to do with the fact that I'm using a simulated account. And to be honest, now that I'm talking about it, I believe I don't have enabled market data, so I'm just getting screenshots, and that's why I got missing data on my option chain here with the Eurex products. Sorry about that. But again, very nice product. There is liquidity, very convenient times as well. They overlap with US markets. You can even hedge an S&P futures iron condor with a Eurostock 50 long strangle, for example. So many things that could be done, which are quite exciting. Okay, we may talk about things like that in future sessions as well. I just wanted to open your eyes to things that could be done. So again, we have, as I said, options and equities. That's not the subject for today. Options on indices. You load the right ticker symbol, the characteristic of a ticker symbol, if it's SPX or NDX, which is NASDAQ, or DAX, Eurex product, or Eurostock 50, Eurex product. So, all those products are an index. So there is no expiration date on the index, and it's not deliverable. So you just input your ticker symbol in your trading platform, and you're ready to trade based on your methodology. That's it. Now, if you go to the family of options, which is FOPs, future options, FOPs, okay? So if you are going to trade options on futures or future options, so now you got to keep in mind what I repeated multiple times today, which is the fact that now you deal with futures contracts which have expiration dates. So, for example, let's say you want to trade options on the S&P futures. So S&P E-mini. So what did I do on TradingView? I just input one exclamation mark. ES one exclamation mark. That is, if I type it and I show it to you, ES one exclamation mark, it's the continuous symbol using the front month. ES two exclamation mark, it's the next expiration date in futures continuous contract. Okay? Well, when you deal with options on futures, you better don't go for the exclamation mark. You don't go for the continuous contract. Make sure you use the expiration date you want. The front month is December. This is where most of the liquidity is. So this is what I want to chart. Okay, and I mean, if you're using an intraday time frame, you will likely see the same thing, because the continuous futures contract typically would show you the same thing in an intraday time frame. But by the way, not on the rollover date, right? This is only once a quarter, but not on the rollover date. So again, because being a good trader has a lot to do with having good habits, just make that good habit, create that good habit, which is when you trade options and futures, make sure you chart the right underlying futures ticker symbol. Avoid continuous ticker symbols. So that way you don't make a mistake with the options contract because you were using the wrong ticker symbol on the chart. Okay, so this is, again, very basic, very normal when you trade options on futures. I mean, that's going to be your bread and butter, muscle memory. You don't even think about it. But today I do need to repeat that same message multiple times with different words, because if you were to make that mistake, you are actually, trading a different thing than what you think you are trading, which could lead to a very profitable trade if you are very, very lucky. Could lead to a great disaster if you didn't know, right? So that's why I need to repeat myself to make sure everybody understands that. Okay. Okay. So what else? Now that you loaded the right ticker symbol, okay, so now you plan your trade. And again, let's say, for example, in this case, you are doing an Aron Condor, using that UFO, and then you are also willing to use that UFO. So let's say this is your Aron Condor. So you are dealing with 4,600 and 4,560. Okay, I'm just rounding numbers. So what would you do? Well, you would go to your trading platform, type the root ticker symbol for the futures. Don't type the whole thing to avoid mistakes. Type the root symbol. Let the platform to present the choices, select futures, and then select the expiration date. Okay. Once you have loaded the right ticker symbol, then the right expiration date will be loading for that expiration futures. And now it's a matter of you selecting the date you want. So I'm assuming that you are doing 0DTs. Okay. Again, I guess it's quite typical. And because recently I conducted sessions on that, so I'm just going with the flow with 0DTs, but it doesn't need to be 0DTs. It could be any other expiration. Maybe you are doing a swing trade with options on futures on the S&P futures. So nothing wrong with that. And then you maybe use an expiration date, 30 days from now. No problem. But I'm going to go with the assumption of 0DTs, 0 days to expiration, daily expiration options. Today is December 7th, so I'll pick December 7th. And now you would just select your strikes. So as said, I was looking at 45.60 and 2 strikes below. Just to have a method here. It doesn't need to be like that either. If you want to take more risks, you can have wider distance between strikes. Again, I am not teaching the methodology today. I'm just using that as an example. So click on that, and then here we go. So you have the option you buy, the option you sell, and then the option you sell and the option you buy. And with all of that, you have your Aron Condor. Okay, but again, it's critical that the way you got to this point was to use the right. I'm multitasking with my thoughts, and I just got stuck here for a moment. Yeah, you use the right expiration future ticker symbol, so you get the right options contract, which is linked with the right underlying asset. Okay, instead of just typing continues, and then you end up with whatever else. Okay. So the main points that I had for today are here, because in the end, putting that on the side, trading options on futures is basically the same thing as trading options on equities. This is really the delicate part that you need to know before you do it. A couple more things I want to mention, but this is really the most important thing. As I said, everything else applies. Everything you ever knew about options, the characteristics of certain strategies, how you measure the risk, what is the margin required, trade management, trade evolution, where maybe you convert an Aron Condor into an Aron Butterfly if a market goes against you. All of those things is exactly the same. Exactly the same. No difference. Okay? So that's important to know. Okay? Now, one more thing I want to mention before we conclude the session. And feel free to type questions, by the way, because we are getting close to the end of the session. So I want to make sure you have time to type your questions. So start typing your questions if you have any question and you don't want to miss the answer before the end. The other thing which is important to know is that certain products are super cool. They have been designed in the electronic age, and therefore the way they have been designed makes their trading very simple. For example, if I load FESX, which is a futures contract for Eurostock 50 trading on the Eurex exchange, that product didn't exist in the 60s or the 80s. You know what I mean? So that product was born during the electronic age. And the beauty of this product, okay, and you can see this product, it's very correlated with the S&P, for example, because it's an index product, index futures product. But the beauty of this product is that, look, no decimal places, right? So if it ticks one, it's 1 point. If it ticks one against you, it's 1 point. It's super easy to measure. It either goes your way or goes against you, and each tick is 1 point. So there is no decimal places. There is no decimal places like certain commodities where you got, movements which are fractions, or like the S&P, which is 0.25 at a time, or like some currency futures, which is like that. You don't have any of that. It's no decimal places. It goes up one, it goes down one. That's it. And how much that makes you or how much that loses you per contract, very easy to remember too. So every one tick, which equals a point, that equals 10, in this case euro, okay, because it's a European contract. The point is 1 is 10. So if you got 10 points in your favor, you made $100. That's it. That's it. You don't need to do the math. With S&P futures, right? With S&P, it's not like it's complicated, but with S&P futures, 1 point equals 50, right? It's not too complicated, but because you have 4 ticks per point, right? So then 1 tick equals $12.50. And again, this is not very complicated. And if you trade S&P futures, you know this by heart. But it is indeed much more complicated than thinking in terms of 1 and 10. And the reason why I'm mentioning this is because, let's say you are building an iron condor on the S&P, like I have here, and you have a distance between 40. Let's say your iron condor is made of. You buy the 4610 call, and then below you sell the 4600 call, and then below you sell the 4560 put, and then you below the whole thing you buy 4550 put. So if you trade on condors that the risk is set by the distance between strikes, and the distance between strikes here is 10 points, and the distance between here is also 10 points. So since I did select a difference of 2 strikes, right, and that equals to 10 points, so it's kind of easy. But remember, those 10 points now need to be multiplied. Need to be multiplied times 50. So the risk of this trade is actually 50 times 10, which equals $500 per contract. Okay? So first of all, you can see that the S&P contract is larger because a movement of 10 points would imply a higher risk, 5 times more than FESX, for example, in this case, the Eurostock 50. But also, it may be confusing or easy to make a mistake. Maybe you have a larger account and you trade wider wings, and maybe now your wing is 46.35. So what happens? Your risk now goes from 35 to 10, which means that now your risk is 25 points times 50, right? So how much is your dollar risk? And it's not a very difficult calculation to do, and we can even do it, in your head. But indeed, it's easy to make a mistake, and next thing you know, now you go with the wrong amount of contracts in the trade because you thought the risk was less, or maybe you go with less amount of contracts because you thought the risk was more. Whereas if you were to do this trade with Eurex options, and since I mentioned DAX, I'll mention DAX in a moment too. So again, it doesn't matter, if your strike increments is whatever. I'm going to pick a random number, these, right? So you got 30 to 80, right? So from 80 to 30 was the distance, 50 points. 50 points times 10, $500, 500 euros, I should say. That's the risk. Okay, so this is the beauty of a market that has no decimal places, that was born in kind of like in computer age. So it's convenient. Same with the DAX. Okay, same with the DAX. So if I look at the DAX, okay, same story. So you have 0 DTs, as we said, and then if you pick two different strikes, okay, the difference between them from 700 to 400, okay, that is 700 points. Okay, that is 700 points. Okay, so you don't need to multiply times 50 or times 5. You don't need to multiply times 50 or times some strange value. You just need to multiply, in this case, times 5. Okay, €5. The DAX, because it's so much more volatile and the price point is so much higher, the point value per contract is 5 versus the FESX, which is a lesser price point, where the point value is 10. Okay, but again, 5 is also a very easy number, because the trick here is to pretend it's 10. So if your risk is 700 points, pretend it's 10. So that would be 7,000 euro of risk. And because 5 is half of 10, so now you divide this by 2, and therefore your risk is 3,500 euros per point if you were to use such wide wings, which this is pretty crazy. If you were to do something much more moderate, maybe 2 strikes, as we did before, so now the distance is what? 100, 250 to 350, that's 100. Well, if the distance is 100, right? If the distance is 100 times 10, that's 1,000 divided by 2, that's $500. So of course, this is a juicier contract compared to the FESX, but again, it's easy to calculate, and it's also no decimal places and all of that. So again, pros and cons of everything. I'm just opening the door to assets that we don't talk about often, assets that you may not have traded, like some of the Eurex products that I wanted to bring in today's session. We are reaching the end, by the way. Ahmed, how are you, my friend? It's good to see you. So I wanted to mention today, I wanted to talk about, just to summarize everything we learned today, right? I wanted to talk about the difference between options on equities versus options on indices versus options on futures. The complexity with futures is, and not a big deal, complexity is fine, but definitely there is an extra layer because you are dealing with options, derivatives on derivatives, right? So the complexity with futures was that when you trade options on futures, those futures ticker symbols that refer to a specific expiration date for futures then become the underlying asset for the futures contract. So you have to be careful with the ticker symbols you use. And then when you calculate the risk of your option strategies, once you have put your strategy on your option chain and your option simulator, the problem is that whatever risk you have in points needs to be multiplied times the point value, right? Needs to be multiplied times the point value, which in futures, depending on the product you trade, it's easy or weird. For example, if you do options on the Euro futures, so each point is $12.5. So it may or may not be easy to remember. It may or may not be easy to make a mistake. With the S&P futures, it's $50. With the Eurex FESX, which I brought as an example of simplicity, it's €10. So no decimal places and €10. Super easy. So again, I'm giving you a collection of choices from more simple, less simple, from more advantageous, less advantageous, so you have a little bit of everything to think about. But, again, the goal of today's session was to introduce you to a new asset class, which is options and futures. I could not do it really without talking about options and indices because it goes hand in hand. So the conversation was, diverse, and hopefully it's all understood. So please give me some confirmation about how was today. I would love to hear your thoughts. If there is something about today that you feel that I didn't cover, that's exactly what your question was. Maybe you're like, oh, Jose, but you didn't talk about this. This is why I was attending today. I was planning to learn about this. So please let me know in the chat box. If I could explain it quickly, happy to do it. If not, happy to create a new lecture for another day and deliver that content another time. So you get what you need. Okay, but this is the time for you to let me know. And if all was good, please make my day and just type on the chat box that, hey, Jose, that was great. That will make me happy for sure. But again, it doesn't need to be like that. You just let me know how it went for you. That's what really matters. So I'll take a sip of water, look at that chat box, and then we'll call it a day. Wow, and I'm not just noticing that I'm looking at my other screen that I never got rid of that caption that was actually covering some of the things that I was doing during the session. I so apologize for that, guys. You guys should have told me on the chat box. Next time, tell me, okay? Sorry about that. Okay, well, this is great. It seems that everything coming in the chat box is all positive. So appreciated. Mark, Ahmed, Sergey, Siva, Michael, everyone attending live, and there are more names on the upper part of the chat box. So sorry if I did not mention your name at this moment in time, but definitely thank you very much for joining me today. If you're watching this recorded, I also thank you very much. And if there's anything I can do to help, as always, feel free to connect with us. Email the question section on our website, tradewithufos.com/questions. That is a useful place. Great. Always happy to joining you for these 1 hour sessions that we do from time to time. So keep up the good work. See you soon. The next one will be next year. The next one like this will be next year. So even though it's probably way too early to say, well, you know what, I'll say it. Happy New Year, everyone. Happy change of year. Happy and good, fruitful end of the year with your trading. I wish you. And but I'll be around. Okay, I'll be trading until the very last day of the year. So anything, emails, and let's stay in touch. And certainly, we'll still do our open meetings in our Discord room. So if you're new to what we do, just come and say hi and join us. Take care, everybody. See you soon. Bye bye.